Okay, let's start with the class. Let's go through this question that I have here. Right, let's start with part A. Part A says Defend-Fi manufacture self-defense weapons in Johannesburg, South Africa. The company's manufacturing process has been approved by SARS as a qualifying process of manufacture. The company is not a small business corporation as defined in the Income Tax Act. The company is registered as Category A value-added tax vendor, making only taxable supplies, and the financial year end is on the last day of March. Then they say the company carried forward an assessed loss. So we should know how do we treat an assessed loss carried forward. It's going to reduce our taxable income in the current financial year. Then they say you have been appointed as the tax manager of ABC Accounting, and Defend-Fi Limited is your new client. The following section relates to the 2022 financial year. Right, so let's check what are we required to do. Remember, I always say you need to check the question. So the question in part A requires us to calculate the taxable income of Defend-Fi Limited for the 2022 year of assessment. So we need to calculate the taxable income. So we read as we go, like I always say. So we start with number one. We don't read everything. We just have to answer, read, answer, read, answer, read, answer until we are done. Okay, so they say included in the sales amount of 4,500,000 is an advance payment of 30,000 received from customers in respect of paper spray order still to be manufactured. The quoted selling price is 85,000 and each should cost 60,000 to manufacture the paper spray. It is estimated that the transaction will be finalized within 3 months after the end of the current year of assessment. The specific gross profit percentage of the data can be applied to the allowance as the commissioner approves the allowance. So which means our sales our starting point is the sales, which is 4,500,000. That's our starting point. So the sales is 4 million. Right, so this is the starting point. So let's check what else do we need there. What are we going to do with the advance payment, which was made there? There's an advance payment of 30,000 received from a customer in respect of a paper spray order still to be manufactured. What do we have to do with this payment? Anyone with an idea there? There's an advance payment of 30,000 received from a customer in respect of a paper spray order still to be manufactured. So we need to deduct the cost here from here, the cost of sale Remember, we have to deduct the cost of sale according to section 24C. So which means we need to find out the cost of sale here. So the gross profit, the selling price is 85,000 and the cost is 60,000. So we need to deduct the cost of sale from here, from this amount, so that we can only tax the profit only. So let's check how do we do that. So in the sales, there is that cost of sale here, which we have to deduct. So we are going to say section 24C allowance. So it's going to be the cost of sale. The cost of sale is going to be, what I'm going to do here is,
$85,000.
okay. Um, Let me just check someone. There's someone who's just. Okay, no problem. All right, no problem. Right. So we are going to say we want what we want here is the cost of sale. So our cost of sale is going to be 100% minus the gross profit, which is gross profit is 25,000 over 85,000 times 30,000. So here we want the gross profit percentage. Then we minus it from 100. 25,000 over 85,000 divided by 85,000 times 100. 29.41. So this one is going to give us 29.41%. That's the gross profit. So we subtract it from 100%, minus 29.41. Then we multiply by 30,000. How much are you guys getting? Are you getting the same as for mine? So this one is the cost. The gross profit is the 29%. Are we together on this one? Are you guys there? Are we together on this?
No.
Where?
No,
Where did you get the 25,000?
Okay, let me just go to the question. That the 25,000. Remember, we want to calculate the gross profit. Ne? So the gross
Mm.
profit is going to be, this is the cost, and this is the selling price. So selling price minus cost is the 25,000
Oh, yeah.
over 85,000 times 100, then it is the one that gives us 29.41%. So for us to get the cost, we can now subtract 100% minus 29.41%. Then we'll get the cost. We are together now.
Yes.
Okay, so we're done with number one. So that was the only trick on number one. Section 24C. It also goes with credit sales. You should also check on. I think we did something with the credit to sale last year in our last question in our last class.
Sorry, Lavmo. I just want to ask, should not we not supposed to then show that 85,000 minus 60,000, or maybe even if we just say 25,000, it will be fine.
Or if we say 25,000,
No, I mean if we are just saying 25,000, it will be fine, or maybe we also have to show the calculation of 85,000 minus 60,000 then.
yeah, you can
It will,
also show that one. Like let me just go to our answer and see. Uh, yeah, you can come here and say you can come here instead of doing what I did here. You can come there and say it's going to be 85,000 minus 60,000 over 85,000. Yeah, it will be fine that way. Yeah, you can show it also here. Right. I'm not sure if we can proceed. Can we proceed to number two? If you guys are fine with that calculation, can we proceed to number two? So on number two, they say purchase amount to 1,500,000 and the cost of opening and closing inventory were. Here, the only thing that you guys need to know about opening and closing inventory. If you are given the cost and the market value, for tax purposes, you take the lower between the two, between market value and the cost. So you are going to take the lower between the market value and the cost. So every time when you are provided with opening and closing inventory, you take the lower. So let's see here, our opening stock and closing stock were 556,000 and 765,400. The market value. So we should compare now here on the opening. So which means the lower is 556. On the closing, which is the lower, is 578. Am I correct? So
yes.
these are the ones that you are going to take. So always, when you are given the market value and the cost, you take the lower between the two. Right? Let's start with the opening stock. So the lower is the cost. So we're going to take the cost, which is the lower. How much is the lower? We say it's 556,000. So opening stock we deduct because it's like cost of sale. Am I right? We deduct that one. Then closing stock is income. So which means this one we add it. So we take the cost again, is the one which is lower, which is 578,000. So that's the only trick here, the law between cost and market value, and also know which one to subtract and which one to add here, so that you know, and you can see here that the opening stock automatically is going to go to the cost of sale. So that one we deduct. And this one is still available. So it goes to be taxed under for tax purposes. Right.
Sorry. I have
Yes.
a question.
Yes.
I have a question about section 24C.
Sorry.
I have a question about section 21C.
The 21, this one.
So yes, the 21177. How did you get that?
Okay.
I understand because is it 30 times 29.41%?
Okay. So what we did here is we say 100% minus 29.41. What do we get there? If you say 100% minus
70.59.
29.41, how much do we get there?
70.59.
So we're going to have, let me just put it here, 70.59%. If you multiply 70.959%, I think we should get this one. If you,
Okay.
yeah, let me just try it again. Maybe there's an error there. It's going to be 30. The only challenge is if your calculator does not allow the percentage sign, then you need to put it in decimal. So there is going to be 7 times
It doesn't
70.39.
as the answer.
Yeah, it's 21117.
Yeah. Thank you so much.
Right. It's 211. Right. Then they were done. And then what else do we need to do? We were talking of closing and opening inventory. I think they were fine on opening and closing inventory. Then what else do we need here? We have purchases. Purchases amount to 1,500,000. What do we do with the purchases? Purchase of raw materials. We deduct that one. The purchases we are going to deduct them. Am I correct? So we're going
Yes.
to deduct purchases. So the 1,500,000 is going to be a deduction. This one is straight. So we're done there. Let's go to the next one. The next one is number 3. Number 3 says on 17 August 2021, Defend 5 purchased raw materials for 14,000 free on board from a supplier in Canada to manufacture chaser guns. The order was placed on 17 August to be delivered as soon as possible, and the debt was paid on 15 April 2022. Right. What are we going to do with this one? the purchase of raw material. It's an import of raw material. When we are here, the most important thing is to see when were the goods sent. So which means the date free on board is 17 August 2021. So what you just need to do is to convert the dollar to the rand here using the date on when the goods were were sent free on board. When they say free on board, it means the moment the goods are shipped, then all the risk and the rewards are now in the hands of the owner. So every time when you see free on board, it means the date that you are going to use is the date when the goods were shipped. That's what free on board means. So it means they are going to be in the ownership responsibility of the owner. Once they are on the ship, all the responsibility, risk, and rewards are now in the hands of. So that is the date when we take when we want to convert our dollar to the rand. So which means the first thing here is to convert 14,000 by 17.89. That's the first thing. So this is going to be raw materials purchased. You can say import, raw materials imported. Yeah, it will make sense if we say import, so that when we convert, so it's going to be $14,000 times the rate on is how much there? 17.89. So that's the conversion. Then we deduct. Remember, they are raw materials. So whatever we get, we are going to deduct it. So it's going to be 14,000 times 17.89 is how much there? 250, 460. So this one is going to be a deduction. Right. Then another thing which you should look there is the foreign exchange gain or loss. A foreign exchange gain or loss. When you determine your foreign exchange gain or loss, you should always look at the financial year end of the company. The financial year end of the company is the year of assessment ends on, I saw it somewhere, they say 31 March, if I'm not mistaken. Where is it? On the last day of March. So this is the financial year end. So if payment is going to be done, like in this case, they say the payment is going to be done on 15 April 2022, which is here. So when you want to compare the foreign exchange gain or loss, and the payment date is not yet reached, so you use the rate on the last day of the financial year end to determine your foreign exchange gain or loss. So which means here we're going to compare 17.89 with 18.45. Are we going to get a foreign exchange loss or a gain here? Is it going to be a loss or a gain? Anyone who can come up with
Again,
Going to be a loss.
it's a gain. Is it a gain
It's a
or a
gain.
loss? Sorry?
It's a gain.
No, it's not a gain. It's a loss here. Right, let me just explain it so that you guys, when you come across a question, you know how to determine whether it's a loss or a gain. Right. These guys, they purchased the raw material when the rand was at 17.89. Now, when they pay now, the rand is now at 18.45. Are they going to pay more in terms of rands or not? They are going to pay more now. If you convert 14,000 times 18,500, it means they are now going to pay more than here. So there's a loss here because here the rand is depreciated in value on 31 March is at 18.45, which means when you convert your dollar to rand now, you need more rands to pay for the raw materials. So it's going to be a loss. I don't know if you guys get what I'm trying to explain there. So it's going to be a foreign exchange loss.
Oh, okay. I get you, love more, but I'm just a little bit confused. So on the 17th, when the goods are shipped, are we not? Yeah, on the 17th August, when they say the free on board, are we not the date that we are buying the goods and then we are paying?
No, you can see that they are going to pay on 15 April here. They didn't pay anything. These people, these goods were just shipped. They just make an order and the goods were shipped. So they are going to start paying on 15 April. So which means them when they make the order now, the rand was at 17.89 cents, which means this is what is on their invoice. On their invoice is 17.89. But when they pay now, the rand is changed. Now it's at 18.45. So that's where the loss comes from there. But in this case, they didn't pay. If they could have paid, let's say here they say they paid, they transfer the money there and there. It means we're only going to convert using 17.89 because they paid there and there when the rand is 17.89. So there was no going to be any foreign exchange loss if they have paid the full debt on that particular day. I don't know if you get the same.
Okay, no, I
Yes, I
get it.
understand.
Even though I'm a little bit
Are you guys
asking.
fine with this? Well, this one is one of the most content level obvious. This question will be there. You need to understand it. Are you fine? Don't just say yes.
I'm just, so what is the use of us then to use that 17.89? So what are we doing with that transaction? Are we
Okay.
not gonna pay?
When you record your raw materials, you are going to use 17.89 in your books, right? So which means even if I think if you have done if you have done FAC, or I'm sure we are going to do also this topic in FAC, foreign exchange transactions. I think it's International Accounting Standard 21, something like that. So what you will see is when we purchase is either raw material or assets on credit, we use this rate to record in our books. Like in this case, they are going to record using 17.89. So whatever happens when they are paying now is going to be a profit or a loss to them. It's like when we record using 17.89, when we go to payment and the rand is gained value, then it means this is going to be recorded as a foreign exchange gain, which is a profit to the company itself. So which means in our record, we use the rate when the invoice was done. That's the rate that we use to record in our books. That's why when we go on, we don't record again when the rand is changed in value. We are now talking of, is there an exchange gain or a loss? I think those who are doing FAC, you also do this topic in your FAC. It's I think it's AIS 21, foreign exchange. You will see we'll also be doing about this foreign exchange gain and foreign exchange loss, because your record is going to take the rand value on the date when the invoice was done. I don't know if it's still if it is making sense now.
No, I understand, sir. Thank you.
You got it. So that's there on foreign exchange, which means your records, your invoice is going to take this one. We don't amend the invoice. Whether you gain or you lose, you are now going to adjust in your financial statement. Right. So that's
So,
yes.
so basically, it's a loss because we're paying more. Is that correct?
Correct.
It's a loss because we're paying more. It's a
Yeah,
foreign loss.
it's a loss now because we are now paying more here.
Okay.
It's a loss because if you convert 14, just convert 14 thousand times this rate, you'll see it's more than this one. So which means that difference is a loss to the company.
Okay. I understand.
You got it now.
Yes.
This question will
Thank
be
you.
there in our test, obvious. The foreign exchange, this one they don't take. It's very rare not to get it in the exam or the test. This one, because it is the one that makes. Remember, Tax 23701 for business. It is from 2601. If you check, most of the things that we are doing are from 2601. So these ones that we don't do in 2601 are the ones they will like to ask more in the exam. Right, so let's go to number 4. If you guys got on the foreign exchange there, then number 4 says the company leases a few of its delivered vehicles in terms of finance leases. The installments are all, so we didn't do the calculation. Let's do the calculation for that one. Sorry. So we agree that we are going to have a foreign exchange loss. For those who are doing FAC, you'll see you are going to do this topic in your FAC. So it's going to be 18.45 minus 17 point what? 17 point, what is the other percentage there? 17.89. Then
Isn't it 18.75?
times 14,000. So let's start by getting the difference, then you multiply it by 14,000.
Sorry, is it not 18.75?
It's 18.75.
I'm not it is, isn't it the date the debt was settled?
No, remember I said, explain this one. When your financial year end is here and the payment is here, it means your foreign exchange difference, you compare the rate on the financial year end, which is 18.45. So you don't compare with this one because you are here now. By the time when we will be in April, you may find that the rate is already changed. So when you compare your difference, you compare it with the financial year end rate. So which means we're going to use 18.45. Okay, so how much are we going to have? It's going to be 18.45 minus uh, minus 18 point,
17.89.
sorry,
Answer is 0.56.
then we multiply it by 14,000.
7,840.
7,840. So this is a loss. So which means it's a deduction for tax purposes. If it was a foreign exchange gain, it was going to be an income. So we're going to add it to the incomes. We're not going to deduct it. So this one is a loss. So we deduct it. So let's look at transaction number 4. The company leases a few of its delivery vehicles in terms of finance leases. The installments are all payable over 48 months. You are provided with the following information: installment for the year, including VAT, VAT element included in the installment, right? So what are we going to do with the lease installments? We just want to remove VAT there. That's the only thing that we need to do. Then we take it as a deduction. It's a general deduction there. So what you just have to do is to remove the VAT. So this one is the lease.
Could you please explain the lease again?
Okay, I was saying on the lease, we just have to remove the VAT there. There is nothing much that we are going to do there. Let me just go there. Do you see? Because here they say it's installments for the year, which means all this is 280 for the year is the one that we are going to deduct. But what we just need to do is it's including VAT. So we need to take out the VAT. I don't know if you get the sense there.
Yes, I do. Thank you.
So which means we're going to take out the VAT there. So there we're going to say taking out the VAT is 100 over, it's what 100 over what? 115, right? Correct?
Yes.
115 times 280,000. You can use 15 over 115, but this one is a straight method. So how much are we going to have? The 100 divided by 115 times 280,000. 243,478. Am I correct? So it's going to be, it's a deduction, it's a payment. Remember, we're still using that general deduction formula. Remember, that's why you see tax is built from the gross income. Understand who makes up the gross income. Understand who makes up the general deduction. That's all what we are doing here. If something is used in the production of income, it's an expense used in the production of income. is going to be a deduction. If it is not used in the production of income, then it's not going to be a deduction. Right. So sometimes I see one of the expense which they normally bring, like which legal fees, legal expenses. They may say the legal expenses for something that is not business related. So which means those expenses are not going to be deducted for tax purposes. So let's do number 5. Number 5 says the data's clerk indicated that the list of doubtful debts amounted to 450,000 and that 40% of the list of doubtful debts are in arrears for more than 60 days, but less than 120 days. Deferred does not apply. For your third level tax, you always use the principle for a company that does not apply International Financial Reporting Standard 9. You will only use both when you do your CTA. That's when you will be able to see if a company uses or a company apply International Financial Reporting Standard 9. How do you treat it? There's going to be a different treatment. So for now, let's just understand for a company that does not apply International Financial Reporting Standard 9, that's for third level. Right. If a company does not apply International Financial Reporting Standard 9, you come here and say all debts which are 60, which are above 60 and less than 120 days, you give them 25%. All debts which are 120 days and more, you give them 40% allowance. So in your question, always look at this. 60 and less than 120, you give them 25%. Then if they are more than 120 days, you give them 40%. Right, so in our case, we say 40% of the list of doubtful debts are in arrears for more than 60 days. So which means we're going to use 25% here. For 40% of the debts, we are going to use 60 days, because here they say there are more than 60 days, but less than 120 days. So which means we're going to use this first line. This one you need to take it down. But what I will say, this is for companies that does not apply International Financial Reporting Standard 9, which is for our third level. They will never ask you for companies that apply International Financial Reporting Standard at this level. Right? So what I'm going to do, 40% of 450,000 is the one that we give 25%. Am I correct?
Yes.
So it's going to be, so just take note of what I have said there on companies that does not apply International Financial Reporting Standard 9. So this one is going to be doubtful debts allowance. So 40% is the one that is, so 40% of 450,000, then 450,000, yeah. Then we multiply it by 25%. I think it's fine like this. How much are we going to have as allowance for doubtful debts? Those who are doing FAC, you will also see that if you will do this when you are doing your FAC, what do you call financial instruments, you will see how do you treat these doubtful debts if a company is using financial reporting, International Financial Reporting Standard 9. We'll do it in our financial instrument. So how much are we going to have here? So it's going to be 450,000 times 40% times 25%,
45,000.
which is going to be 45,000. This is a provision, so we deduct it. Right, then let's go to the next, if you guys are fine with this part. The most important thing is to understand, because remember, we are not going to have the same question like this. We are using this question for learning purposes. So which means when we are answering this question, we should understand also the principle behind, so that when the question comes in another way, because in some of the questions like this one, they can give you all of them. They can say 40% of the debts are more than 60 and less than 120. Then they will say 20% is more than 120 days. So which means you need to apportion and include both in your provision for doubtful debts. Right, so let's do number 6. If you guys are fine on that one. Oh, we're almost done here. So number 6 says the following information relates to the asset held by the company. These are the assets held by the company. The moment you go to the assets of the company, then you should think of capital allowance for tax purposes. Capital allowances, all the assets of the company should claim a capital allowance so that it can reduce their tax liability. But the main reason for allowing companies to claim these expenses, business expenses, is to reduce their tax liability so that they can pay less in terms of tax, so that they can also be able to go back to operate in the business. So that's the main, so everything that has to do with the running of the business, any expense for running a business is going to be a deduction. Right, so let's look at the assets for the company. They say Defend 5 purchased a plot of land on 10 July 2008 and erected a factory building on the land. The plot of land was originally acquired for 450, including VAT, and the factory was erected on 1 October 2008 for 990,000, including VAT, and brought to use on 30 November 2008. As Defendify is a VAT vendor making 100% taxable supplies, the company could claim input tax on the original transaction for the plot of land and the factory. So which means here, these guys can claim input tax. Whatever figures you are going to use in your calculation for tax, you need to remove input tax there. Right, then they come here and say the following costs were incurred while the company owned the factory building and plot of land. There was a bond registration cost, interest paid on mortgage bond, improvements to the factory building. So this one is going to be an asset. It's going to increase the value of the factory building, the improvements. So which means we have to claim capital allowance here. Then advertising cost, find a buyer for the asset. Then they come here and say the plot of land and factory building was sold as a unit on 31 January 2022 respectively for 500,000 land and 2 million factory to an unconnected person. Right, where do we start? The moment they talk of selling, then you should know what we need here. We need the recoupment, the capital gain, all those are required. The question will not tell you, but if an asset is sold, you should look for the calculation of the recoupment and the capital gain of that asset. So where do we start? Remember when we say, when we want to calculate the recoupment, let me just come in. This one is going to be long. So this is the factory building. Right, on the factory building, they sold the land and the factory. So which means we need recoupment there. So how do you get your recoupment? Your recoupment is equal to selling price minus tax value of the asset. So which means here we need the tax value. The tax value of the asset is the cost price minus capital allowance. So we can have the tax value of the asset. So the cost of the factory, the only, I think these two assets, let me just go there and see. The cost of the factory is going to be what? 990 excluding VAT. There's a trick here. When was VAT increased to 15%? 2018, am I right?
Yes, sir.
So which means here, this one was done before VAT was 15. So we're going to use the 14% here. We're going to use 14%. It's very important for tax to know all those. When was VAT increased? When was all those? So which means the cost of the factory building, we exclude VAT, but we are going to use 14%. So it's going to be 100 over 114 times 990,000. How much are we going to have here? It's 990,000, yes. So this one is going to give us how much? 8.
I'm sorry, I have a question.
Sorry?
I have a question.
Yes.
So we look at when the factory was erected.
Sorry?
So we look at the 990, it's when the factory was erected.
You're saying on the VAT.
Yes, the 990. Where did we get that amount from?
That's the factory building. It was erected for 990,000. So that's the cost.
That's the cost of it. Okay.
Yeah, that is going to be the cost.
So erected means that's the cost. Erected is the cost.
Sorry?
Erected is the cost.
No, they built it. They build. Remember, if you check from the, it's a way of saying they built this thing. They bought a land and erected a
Yeah.
factory building on the land. So which means they bought it and built a factory building there.
Mm.
So these are the costs of building, 990,000. So that's the cost of the factory building.
Okay. Thank you.
So that's there. Then, so we want to remove VAT. How much are we going to get there? I got on my calculator here 868,421. Right? So that's there. That's excluding VAT. Then let's look at the capital allowance for the factory building. Where do we start to remember capital allowance for buildings? It's how much? Is it not 5%? It's 5%. Right. So here what we need is the number of years from 30 November 2008 to 31 March 2022. How many years are there? So we can say 2008 to they sold it on which date here? 31 January 2022. How many years are we looking at here? 14 years, am I right? Remember, we don't apportion for buildings. We don't apportion. Even if it is 1 month, we count it as a year. We don't apportion. So it's going to be 14 years. So that 14 years for the capital allowance of the building, so it's going to be 868,421 times 5% times 14 years. How much are we going to get there? Eight six eight 868,421 times 5% is 43. So the one for the year we have to include it. 43,421. This one should come here as a deduction, as a capital allowance deduction for the year. Then we multiply the one by 14. So it's going to give us 607,895. We round it. So this is the capital allowance. So once we have our capital allowance, we need the tax value. What is going to be the tax value of the building here? Of the factory building. So we say 868,421 minus 607,895. How much are we going to have as the tax value of I got here 260. Are we together on this thing, you guys? Are we together? This is the tax value of tax value of the factory building is 260,526. What else do we need here? There is that improvement. The reason why we should not put them together, you can see here, the improvement, we cannot calculate the capital allowance for the improvement together. So the total for them before the capital allowance, we can't calculate it because they are different when it comes to when they were purchased. So which means here we also need to take into account the improvement and then take out the capital allowance for the improvement. On the capital allowance for the improvement is 2016 to 2022. So which means it's going to be 6 years there. It's going to be 6 years. Are we together on this one, you guys? Are we moving together? These are the longer questions that you need to understand in the exam so that you will be able to. So we have improvements also.
Sorry,
Yes.
where did we get the 43,421?
Oh, this one is, it's 5% of this one will give us 43,421. Remember the capital allowance for the current year, we must deduct it. So if you say 868,421 times 5%, you'll get this one. This is for the year. Then this one now is for 14 years now. The 607,895 is for 14 years.
Oh, okay, now I understand.
So the improvements is equal to, are they including VAT? Okay, who is including VAT? Who is the land? The improvements, they never talk of VAT there. Improvements to the factory, there is no VAT there. So we don't need to take out the VAT from there. So which means we are going to say 250,000. Then we take out the capital allowance. It's going to be 250,000 times 5% times 6 years. The one for the current year, we should take it this side. The 250,000 times 5%, which is 12,500, we should take it this side. Then we multiply by 6. So as to get 75,000 here. Then the tax value. The tax value is going to be 250 minus 75,000. So the tax value of the improvements, it's 175,000. Am I correct?
Yes.
Right. When we have this one, what do we do now? These things were sold as a unit, yeah. So which means we need now the total for them. The total of their tax value. Total of tax value. Total of tax value, it means we're going to add 175,000 plus 265.26. How much are we going to get?
425,000.
435, 526. Am I
25.
correct? Huh?
Oh,
430,
yes.
435, 526, né? Like this. So this is the total tax value. So what are we going to do when we have our total tax value? We compare the tax value with the selling price. Am I correct? We compare so that we can get the recoupment. Remember, recoupment is equal to tax value less selling price. We get our recoupment. So this is our tax value. Then we less the selling price. So if I am not mistaken, they were sold at 2 million. So the building was sold, the factory building was sold at 2 million. So that it was sold at 2 million. So here we now say selling price 2 million, right? What is going to be our recoupment? The recoupment is the difference between the tax value and the selling price. If the selling price is higher than the tax value, it's a recoupment. If the selling price is less than the tax value, it's a scrapping allowance. So in this case, we have a recoupment. Am I correct? How much are we going to have there?
$1,564,474.
Okay. $1 million. So the recoupment is going to be 1,564,474. Then what do we do with the recoupment? The recoupment,
We increase
according to here, is going to be limited to capital allowance claimed. So which means you limit it to capital allowance. So when you limit it, so which means the one for is 75,000 there plus 607. What is the one for the building? It's 607,895. So what is going to be our total capital allowance claim? Are you guys still there or 607,895? So this is going to be 682. So you can see 682 is smaller, so we can limit it. But if the capital allowance are greater than this recoupment, it means we take the recoupment. So here the capital allowance is smaller, so we limit it to. It's an advantage for the taxpayer on this one because it's going to be taxed on less on this recoupment. Right? So we're done on. So when you are doing questions which involve capital gain, it means you should come here and have your taxable profit. Sorry, not profit, it's income. Before capital gain. Remember, whenever a person is sold, he has sold an asset here, he is going to be taxed on the recoupment and on the capital gain again. So which means we need now to do the capital gain. So our capital gain is equal to, oh, can we do, it's gonna take us time. Our profit, let's just quickly do our, but I don't think it's necessary. Okay, so here we'll calculate the taxable income before capital gain. We put it here. Then we need our capital gain. On the assets which were sold. So capital gain tax now is equal to, what's the formula for capital gain? It's selling price less what? Less base cost. That's the capital gain. Capital gain is adjusted selling price, then you less your base cost. Then you have your capital gain. So let's start with the adjusted selling price. Adjusted selling price is equal to your selling price minus recoupment. So let's start with the adjusted selling price. So your adjusted selling price is equal to your selling price less recoupment. What is the selling price for these two? Is 2 million, am I correct? It's 2 million. Are we together? Are we still together, you guys?
No. Could you please explain again?
Where are we? So the selling price is what? 2 million. Then we less our
Yes.
recoupment. Then when we less our recoupment, we have our, so we're going to say here, selling price is equal to 2 million. Remember, we say capital gain tax here. We say capital gain tax is equal to adjusted selling price here minus base cost. So this is the calculation for adjusted selling price. Our selling price less recoupment. So the recoupment you use, the one that you have said is the limit, the limiting one. 682,895 is the one that we are going to use. So we say 682,895. So our adjusted selling price is the difference between these two. How much are we going to have there? We minus 2 million. 1,317. 1,317,105. So this is the adjusted selling price. Remember here that why we want, if you go to those notes and the recording that I sent on the class for capital gain, you'll see what we are talking about here. So which means here we say adjusted selling price. Remember here we say capital gain tax is adjusted selling price minus the base cost. So this is our adjusted selling price. Then we want the base cost now. So we have our adjusted selling price. Then we want to calculate the base cost so that we can find the difference between the two. Right? So the base cost, we start from how many assets do we have here? So our base cost is going to be, let me just go to the question. So our base cost, we are going to take this amount plus this one excluding VAT minus the capital allowances. Then we get our, let's just go there. So our base cost, we can say here, our base cost is going to be 868,421 plus the 250,000 minus what? Minus the capital allowance. So the one for the improvements is capital allowance for improvements is 75,000. Then the capital allowance for the factory building is 607,895. So we subtract those. So we're now going to say our base cost is 86 plus this one, then minus 75,000. The capital allowance for the improvements minus the capital allowance for the factory, which is 607,895. How much are we going to have here?
Four, 3, 5, 526.
4, 3, 4, 3, 5. You say 4, 3, 5.
526.
4, 3, 5. Are they 555 or what?
435
Yes.
526 55.
Then 26.
Yes.
That's then, eh? Right. Then you need to check from here. Remember, we're selling. The best cost when you are selling is going to increase. Remember, we're selling these assets. So the best cost is going to increase by here. There's someone who must increase the best cost here. What are we going to do with the bond registration cost? They are not going to increase our base. Interest paid on mortgage is not going to increase the base cost. Improvements, advertising. So which means we're only going to increase by advertising to find a buyer here. To increase is the one that is going to increase our base cost. So we come here and say advertising cost. So we add advertising cost. Advertising cost is 15,000. So if we add 15 here, it becomes 450, 526. Am I correct? Are we together until the 450 there?
Yes.
Then what do we do now? We have our base cost. What are we going to do? We have our base cost now. So now, remember the question was saying, the answer here, the formula says capital gain, adjusted selling price, less base cost. So which means we are done with the calculation. What we just need now is the capital gain now. So which means this is our base cost. So we just need that adjusted selling price, or we can just come here. But there's something that I saw here. Your base cost must also be adjusted by your selling price must also be adjusted by the land. And it must also affect your base cost. So if you look at your base cost for the land, it's going to be 450. It's including VAT. So which means when you calculate your base cost for the land, you need to take out the VAT. You need to take out that VAT. So which means we can come here now and say, okay, these are the type of questions that we should expect in our. So let's just come here and say, do I still have space so that we can just jump here? Let me just check my space. Yeah, we still have for the next question. Right, so I want now us to calculate the capital gains. We have everything that we need there. So we can now say our capital gain. Then we say our adjusted proceeds. We take the one that we adjust. The 1,317,105, and let's not forget the one for the land, the 500,000. So it means we are going to say 500,000 plus the one that we adjusted, 1,317,105. So this is going to give us the adjusted profit. How much are we going to get there? We just add 5 here. So it's going to be 1,800,000 17,105. Then we less base cost. Our base cost is going to be 450, the one that we calculate, 526, 455, 26 plus the one for the land. It's plus 100 over 114 times, sorry, times 450,000 here. How much are we going to have here? 450,000, 100 over 114 times 450,000. Are we together here? Here we want to take out the part. How much are we going to get when we take out the part? 394, 394, 737. According to my calculator, 394, 737. Then we add to here, plus 450, 526. So it's going to give us 845, 263 if we round. So that is going to be our base cost. Am I correct? Are we together? Are we together? Then we have our capital gain now. Our capital gain, the difference between the two is going to give us the capital gain. What are we going to say on the capital gain? Is minus this one minus this one. Are you still guys with me, or I'm alone here? Are we still there?
I'm a bit confused.
Yes,
Yes.
sir. Are we lost or following? I want you guys to understand this. This is what you are going to get in test 2. If there is no this kind of question, then there is no test 2. Test 2 prepares you for question 1 for the exam. Remember, when we go for our final exam, we'll have 2 questions only. The question 1 will be this for business taxation. Remember, we're done. When we are done writing our test 2, we are done with business taxation. Then when we come, we do individuals. So there will be 2 questions, one for business and one for individual. That's the structure of the exam. Maybe here and there they can add small questions. So our capital gain is going to be how much here? It's 971, 842. Right, what do we do with the capital gain? The inclusion rate, am I correct? The inclusion rate for companies is 80%. You guys, you didn't go through those classes that I sent. So it's going to be 971, 842. Inclusion rate is 80% for companies, 40% for individuals. So here we are dealing with a company, so we're going to take 80%, right? So how much are we going to include here? It's 971, 842 times 80%. So it's 777, 473.6. We can round it to 474. So that is going to be the inclusion rate, right? So when you are here, I don't think we'll have time to. So you come and say, take example, income before assessed loss. So which means you should now come here. We will not be able to, because I want us to, the time for that other question. I want us to do all the questions. Right. So which means you start from here. This was your taxable income before capital gain. Then you take it and you add the inclusion rate. You come here and add the inclusion rate. Then you get your taxable income before assessed loss. Then you now less the assessed loss. In our case, our assessed loss was 56,000. That's the assessed loss. So which means we now have our taxable. So which means we add here and less assessed loss. Then we have the taxable income for the year, which is going to be here. Remember, this assessed loss, what we say is assessed loss. We say assessed loss is a situation when the company is less income as compared to deductions. So it's going to end up having an assessed loss. So that assessed loss, SARS does not allow you to claim it. They just say you carry it to next year. It's going to reduce your taxable income for next year. So that's why we take it down, which means your assessed loss for this year, you carry it to next year, then it's going to reduce your taxable income for next year. That's how SARS work. They normally don't want to refund. They always say you carry it over. Right? Questions before we try to check if we still have time for the next question. Any questions before? I want you guys to understand this part. If it means we should have another. Yes.
Okay, sorry, Lavmo. I want to ask about the assess the losses. I did not actually understand. So the 56,000 is an amount of the previous year.
Yeah, it's an amount of the previous year. You can see here.
That was that the company is owing SARS or the SARS is owing the company.
No, you know what happens here is, let me just put it this way. You see here, we are calculating the taxable income for Defendify here. Am I correct? So when we calculate the taxable income here, and at the end, our income is less than the deductions. You get the sense? So which means an assessed loss is like a negative. A negative. Like in our case here, our sales, when we minus all the deductions, then we end up having a negative here. I don't know if you get the sense.
Yes, I understand you, sir.
Yeah. So that is the one that you carry to next year. So that is what you will now carry to next year.
Oh, so you will keep on carrying it each year until you make positive.
Yeah, the
Because,
the one for this year you carry it to next year. The one for next year you carry it to next. You can't carry. If you keep on getting assessed loss, you carry the balance for that particular year, which means you adjust the one for last year. After adjusting, then you see what, if you still have a loss, then you carry that one that you have adjusted to next year. So that's how.
okay.
So that's how
You see,
you. But in your questions, most of your questions for third level, they always give you the assessed loss here. They always give you the figure. Right, any other question before we go to, I want us to, maybe we can be able to do part B. It's not very long. Any other question before we do part B? Right, if there is no
Yeah,
question,
can we have time to digest part A before we do part B?
sorry,
Can we have time to digest part A before we do part B?
or you want to digest part A?
Yeah, because
You want like to how to digest how, like we can leave it now, like now.
I think we need to go over it again before we do part B.
There is no more time for that. Why don't you follow the recording for part A after the class?
Okay.
Yeah, I think you guys, you must also try to check. You see the one that I sent for capital gain, all those. I think if you can check them, they will also help you. Right. Okay, so let's just do B. If you guys don't get something, I'm always available. So let's try to do B so that you see also how you do such a question. Even though you are not gonna get it 100% understanding, but let's do it so that you see how we do it. So let's go and do part B. Part B says Mr. Mabena is the financial director of Defend5. He has been married to his wife, Miss Senzel, for 25 years, and they are married out. I don't know why they put this thing here. It was not supposed to be. This one is normally, you will understand this when you do individuals. That's when you know how do you treat something if it is they are married out of community of property. But I don't think it's going to affect much. Let's see what they are saying. They say Mr. Mabena purchased a 3-bedroom flat in Cape Town on 1 April 1999 for 255,000. That was rented out as holiday accommodation. The flat has been rented out for the past 22 years, and Ms. Mabena recently decided to sell the flat and buy a larger house in Cape Town where they could live. During 2005, Ms. and Ms. Mabena had improvements done, right? 2005, they had improvements done to the flat for 320. On 1 October 2001, the flat was valued at 1,200,000 and the term cost was 351,815, and the flat was sold for 2,900,000 on 1 July 2021 to an unconnected person. Calculate the taxable capital gain for the 2022 year of assessment. Right. If you check there, in the class for capital gain, these questions are for capital gain. You'll see there is where we say the method that we're using on capital gain for the first question is assets purchased before or after. The one that we do is assets purchased after 1 October 2001. That's the method that we use there. Then there is a method, if you check there, for assets purchased before 1 October 2001. So whenever you are doing capital gain, you must always look for that. Like if you check this asset was purchased before 10 October 2001. So which means we are going to use paragraph. So this one we use paragraph. If you check there's paragraph 26 and paragraph 27. I'll explain what this paragraph means. So which means if an asset was purchased before 1 October 2001, you treat it using paragraph 26 and paragraph 27 of the Income Tax Act. So in that case, if you come here, you can see this one was purchased before 1 October 2001. So which means it's going to fall under paragraph 26 of the Income Tax Act. So on paragraph, right, let me just go and write something there so that I'll explain as we write. So that's capital gain. I think it's very clear if you check on the notes in the recording that I said there. So this is our part B. Even especially the notes there, everything there. So in our part B, we want to calculate the capital gain tax. Capital gain tax. And the asset was acquired. So our calculation for capital gain tax is going to be proceeds less base cost. That's how we calculate. It's going to be proceeds less base cost. The one that is difficult to calculate is the base cost. So let's now calculate the base cost. So the base cost is equal to valuation date value, the value of the asset on 1 October 2001 plus expenditure after 1 October. So that is going to be our base cost. So our base cost now is now going to be determined by the valuation date value. So which means here we want to calculate the valuation date value. So in the calculation for the valuation date value, you first need to calculate cost before 1 October and cost after 1 October. So you go to the question and look for the cost before and cost after. So our costs before include the purchase price. So they bought this thing for 225,000. That's the cost before, nothing else. The 320 is for 2005. So that one is going to be the cost after. So our cost before is going to be 225,000, the purchase price. So which is going to be the cost before 1 October is 225,000. Then the cost after is going to be 320. Then we add the two. How much are we going to get there? We have 5 here, 4 here, 5 here. So it's going to be 545,000. Then you look at the proceeds. How much did they sold the flat? So that's the proceeds. Here we don't talk of adjusted. We are not going to adjust. When we are using paragraph 27 and 26, we only use those for the adjustment when we are doing for assets which were acquired after 1 October 2001. But so here you come and look at the proceeds. The flat was sold for 2,900,000. So that is the proceeds. If you check on paragraph 26 and 27, you are going to see that it might appear difficult, but it's not very difficult. As long as you understand the. So when you have your proceeds, our proceeds are going to be 2,900,000. That's our proceeds. Right. So what determines whether you're going to use paragraph 26 or paragraph 27 is here. So you are now going to say if proceeds are greater than total expenditure, you use paragraph 26. Then if proceeds are less than total expenditure, you are going to use paragraph 27. So ask which paragraph are we going to use here? Which one are we going to use? Our proceeds is greater than total expenditure. So which means we're going to use paragraph 26. So if you go now to paragraph 26, it will tell you that once you choose this line, it means you are going to use paragraph 26. So it will tell you that the valuation date value is the greater of market value which means you are going to choose here. The time apportion, you are not required to calculate this one immediately. You are always given this term. Then the 20% rule. So our market value, let's just go to the question. So our market value is 1,200,000 and our term is 351,815. The 20% rule is selling price minus expenditure after 2001 times 20%. So that's how we get those figures there. So we come here and input our figures. So which means here is our market value. We have it, 1,200,000. The term, we have it. It's 351, 815. That's the term. The 20% rule, you say selling price which is 2,900,000 minus expenditure after 1 October, which is there 320, then times 20%. So that's the 20% rule. Your selling price minus expenditure after 1 October, then we multiply it by 20%. How much are we going to get there? Minus 320 times 20%, 516,000. So who is the higher? Who is going to be our valuation debt value? The valuation debt value is the value on 1 October 2001. That's the valuation debt value. So which means here we say is the greater of. So who is greater here? Is here, the market value. So if you go back now, so the valuation debt value, if you go back now, we now have our valuation debt value. Then we want the base cost. So our base cost is equal to valuation debt value plus expenditure after 1 October 2001. So which means here, our valuation debt value is equal to 1,200,000. That's the valuation debt value. Then our base cost is now our valuation debt value, which is 1,200,000 plus expenditure after 1 October 2001, which is 320,000 there. So how much are we going to get all in all? We just add 320 here. So it's going to be 1,520,000. That is going to be the base cost. So our capital gain is proceeds. Oh, I no longer have space. I've used too much. So our capital gain is, we come now and say proceeds. Our proceeds is 2,900,000. 2,900,000, that's the selling price. Then we less base cost. Our base cost is this one, which is 1,520,000. Then we get our capital gain. How much is going to be our capital gain?
1,380,000.
1,380,000. And Mr. Mabena is an individual. For all individuals, there is an annual exclusion of 40,000. So you need to less the annual exclusion of 40,000, which is 40,000. Then how much are we going to have? It's 1,380,000 minus 40,000. 1,340,000. Don't confuse the annual exclusion and the inclusion here. So the inclusion is going to be 40% for individuals. 40% times 1,340,000 thousand. This is the amount that we are going to include for capital gain. So we're going to say times 40%, which is 536,000.
So for the companies is 80%.
Yeah,
Right.
for companies it's 80%. I don't know why they include this question in this test, because this is for an individual. You understand it more when we do individual taxation. I don't know why they include this individual. For companies, the inclusion rate is 80. For individual, it's 40. And individual, they have an advantage. There is an annual exclusion of 40,000. Before you apply the 40%, you need to take out the 40,000. Then the remainder is the one that you apply the 40,000. That's the annual, that's the for individual. So which means capital gain, it affects more on companies than on individuals. Right, so what I want you guys on capital gain, I want you to check here, paragraph 26 and paragraph 27. The first thing that you need to check, when do I use paragraph 26? I think it's here. If the proceeds are greater than total expenditure, it means you are going to use paragraph 26. If the proceeds are less than total expenditure, it means you are going to use, it's clear, if you check there, it's very clear how do you, when you are on paragraph 27, how do you treat paragraph 27? When you are on paragraph 26, how do you treat paragraph 26? So I want to check on, because obviously test 2 capital gain is there. There is no way. That's why you see there's a lot of capital gain testing here from here. So the first one here, the first one that we did here, it was for assets after. So always take note of the date when the asset was purchased. So this one was after 1 October 2001. So you should treat them differently. The one before and the one after, you treat them differently. So which means the one after is the one that we have to do the adjusted process, all this. Then the one after, that's when now you need this evaluation date value, market value, and the term. The term for now, just know how to use it. I don't think it's necessary for you guys to stress yourself with the term. You will understand it more when you do your CTA. For now, just know how to use it here. You will understand how to calculate it when you are doing your CTA. Those who do honors or CTA. Right, I think that's all for today. Unless if you guys have a question, then you can ask before we close the class. I think you can also try as much as possible to go through this recording, and the one that I said and the ones that we did, the class, especially the long questions, yeah, you will see, you will gain something there.
So is it
Unless if you
just to
guys have a question, then we'll meet on Saturday for those who are doing NEC, but I'll check if there's another question I'll send. I'll check another question. I'll send another question to you. I'll send it. But first, try to go through the one that we have just do. Right?
so is
Unless
it just these
hello?
two? Hi, is it just these 2 topics that are coming out?
Sorry?
Is it just these 2 that are coming out in the test?
You
Or
want,
is it VAT as well?
you want me to scroll down?
No, is VAT coming out as well, like input VAT and output VAT? Is that also coming out?
I think the network is, you are saying, you are saying
Is input VAT and output VAT also coming out in the test?
No. That is not here. Don't stress yourself with that. Let me show you. Let me just show you what you should stress yourself with. It's more or less like here. VAT for now, you can leave it. For now, go through the question, the work for deductions. What do you call it? Deductions.
The general deduction formula.
If you can understand the deduction formula, but try as much to go through the actual deductions here. And
Okay.
also the capital allowances. There's a topic for capital allowances and deductions like what do they call it? They call it specific deductions. Yeah. Check on specific deductions and capital allowance and capital gain. Those are the topics for test 2. VAT.
Capital allowances, what's that?
Capital allowance is for, I think you will see it on the notes, the one that we allow for assets. For example, if we buy a machine, we give it an allowance for, if it is new, we say 40% in the first year, 20% in the second year, 20% in the third year, and 20% in the fourth year. It's too much now. So it must end year 1, 2, yeah, there must be another 20 years. Those are the capital allowance is something like it's like depreciation. So for SARS purposes, you are required to claim it.
Like wear and tear.
Sorry?
Is it like wear and tear?
Yeah, it's like wear and tear, yeah.
Okay. Thank you.
Okay, I'll send the recording just after this class so that you guys can also go through it.
Okay. Thank you. Thank you, sir.
Thank you.
Bye-bye.
Okay, let me just say this. Takes,